Hello traders, Gary Wagner here just after 12 noon in Honolulu, 6 o'clock in New York. It is Tuesday, 18th day of June 2019, and this is the daily report for gold and silver. And what a day we have witnessed. Gold closing at the highest trading point this year. We're in after markets now, so it's showing down 60 cents, but there was a gain today of about $7-8. $1,350.10. The high was $13.50.80, so we're just off of the high, and the low today was $13.50. In other words, it's counting just this most recent activity. It was quite a spectacular day with the other metals also moving higher, with the exception of silver, $14.99. That puts it down just a little bit. We had palladium trading at $1,474.50. And lastly, platinum trading above 800 again at 803.40. Dollar index was a little bit stronger, so a little bit of headwinds there. But the good news is we have an active trade right now in which we are long at 39. We have our stops set at 33. The market's at 1350. Our main topic of discussion today is where we plan on moving our stop, and most importantly, what are our potential exit strategies. Traders, of course, tomorrow is Fed Day, and anything can happen. But let's first take a look at our straight technicals and see what they're telling us. We're looking at a weekly chart of a Japanese average format. Of course, the Japanese average format takes the midpoint of the prior candle and fixes that as the open. There are two main factors that we look for when we look at this type of chart. First, is there an absence of lower tails on the way up? Because what that tells us is that at no point during the trading session did prices go at or below the midpoint. We see that for the last 3 weeks in a row. Although this is a smaller candle, traders, it is only Tuesday. So it is pretty large as far as I'm concerned for 2 days in trading. And then the next thing that we want to do is then take a look at our daily Heikin Ashis. So let's go ahead and convert that. And traders, when we do that, we see quite a different picture. In other words, we see the entire rally over the last 3 weeks, but we see that it wasn't a straight linear line up. We had some extremely strong moves at the beginning. We had this very, very tight correction. And then the last couple of trading days have really been defined by smaller bodies. And we had a wick here as well as a wick here, the lower wicks. That tells me that on a short-term basis, this trend itself is beginning to weaken. That being said, where can we look at for various points of support as well as resistance? To do that, we do want to look at a candlestick chart. And traders, as you can see, I have just put up a candlestick chart, and here's what we're looking at. The fact of the matter is we are at an all-time record high for the year of 2019. Prior to that was this candle right here, which came in roughly at 47. We closed at 50, so $3 above that. But we are certainly at a level in which we could, in fact, find some resistance. At the same time, we have had multiple scouting parties. We've talked about this pattern type on many occasions, and that is a point in time in which the bulls are testing the fortitude of the bears, which are pretty strong because every time they have moved the market higher and above this price point, the bearish faction has been able to move it back down. Nonetheless, we closed right above it. We're at 1350, and this is at 1349.70. So we are very, very close to that record high. My sense is that this will be fundamentally driven or fundamentally based upon the statement that is read by the Fed tomorrow. First of all, there is a very low probability that they will announce the implementation of a rate hike tomorrow. The probability is around 20%. I believe it's 18.2. The probability of a rate cut. The probability of a rate cut the next month in July goes up to about 80%. And so my sense is with everything going on fundamentally and the geopolitical hotspots, we could see this market move sideways for a while. We could see it move higher, but we could also see it retrace ever so slightly, which brings us to our current trade, where our stop is and where we should move that. To do that, I do want to look at a much shorter term timeline in terms of the chart. And traders, as you can see, we have converted our daily to a 720-minute chart. Each candle represents a half a day in trading. Of course, we now have 24-hour markets. The second thing that we have done is put a very, very short fib retracement, which basically covers 1267 back in May, all the way up to this top here that comes in at 62, also accounting for these tops here. Our first real level comes in at around 1340. We went long at 1339. We currently have a stop at 1333, and 1333 to me does not make a lot of sense. So, as a protective measure, my recommendation is going to be to trail our stops from 1333 to 1340.13, 1340.13. At least if we're stopped out with a profit, a very small profit, but a profit and not a loss. We took 4,500 out of the last trade, a 45% profit. I certainly don't want to give it back on this trade, but here's my sense. If the statement that comes out from the Fed is conceived as bullish for gold, we're going to see the market move up, and that stop should be just fine. If in fact statements are made that are bearish in terms of market sentiment towards gold, we could see the market easily move down past 40, even as low as, say, 1330. So traders, I'll put this out as a special trade alert to move our stop to 1339.13, maintain our long position at 1339, and see what happens at the Fed meeting tomorrow. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow after the Fed meeting. Have a great day. Bye-bye.